Okay, good morning, everyone, and welcome to this morning's edition of the Coffee Microcaps morning meeting. My name is Mark Tobin. I'm the founder of Coffee Microcaps. For anybody who's joining us for the first time, I'm just going to quickly run through a couple of these intro slides, and then we're going to get straight into it with our first presenter. First off, I'd like to acknowledge Meriwether Capital, our sponsor for all our virtual events. The fund, I believe, is launching the 22nd of November. So if you want to get in touch with Luke about his new microcap fund, please reach out to him on the email or via his website. Quick compliance and disclaimer side. And for anybody joining us here this morning for the first time, the companies we generally have presenting here on a weekly basis are capped under 300 million. They're in revenue and approaching cash flow break-even, or indeed are already profitable. We tend to not have companies from the resources and biotech sector. So we have what I call industrial microcaps, which is a catch-all term for microcap technology names, microcap financial services names, microcap retailers, healthcare, anything kind of outside resources and biotech. Structure this morning's webinar, and we're going to have two companies presenting over the next hour, which we're going to break down into a 20-minute preso and 10-minute Q&A for each company. If you do have any questions for our presenters, please type them in the Q&A box rather than the chat function. Just makes it easier to moderate the questions when we get to Q&A. Please note the webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel tomorrow morning. You can follow Coffee Microcaps on all the various social channels, Twitter, YouTube for this recording, as I said, and all our previous events are on there, LinkedIn, and I also write a weekly paid subscription newsletter where I profile one interesting ASX microcap stock every week, and you can find it on the Substack newsletter platform. Up first, we're going to hand over to Sir David Caspari and Stuart Halls from Janison. And then after that, we've got Scott Alomes and Michael Constable from Millennium Services Group. So I'm going to stop there. So I'll stop sharing my screen, and Stuart or David, if you guys want to bring up your slides, I'll let you know when it's coming through on your side now, Stuart.
You see that
yeah,
now,
I can see that. Yeah, I can see the cover slide now, Stuart. You're good to go.
Great.
Thank you, Mark, and thank you for having us back at your Microcaps coffee session. I think the last time we had the opportunity to join was in December of last year, and wow, it's been an extraordinary nearly 12 months for Janison as a business and the team. We're delighted to provide a trading update this morning for FY22. Look, and it's building on a record FY21 that we'll take you through. You know, it's fair to say momentum has continued in Q1, and we see strong underlying revenue and gross margin growth in the first half. As I start, I'm also delighted to let everybody know that in the next hour, there'll be an ASX update with the appointment of Vicky Aristodopoulos as a independent non-executive director for Janison. Really great addition to Janison's board, continues to progress our focus on diversity, but has extraordinary experience most recently as the CMO of Afterpay. Before that, the CMO of Fox, the CMO of News Corp Australia, 20+ years in the corporate world. She really brings very strong go-to-market focus, particularly as we start to focus more on B2B2C in the schools, marketing strength, digital strength, and very strong SaaS knowledge. So we're delighted to have her with us. In terms of our content today, many of you have been on the journey since the listing. Many of you might have been on our session in December last year. Equally, we've seen breakout growth in our register. So we'll take the opportunity to very briefly step through a business overview, and then we'll take you through our growth drivers for that will see us get to 80 to 100 million of annualized recurring revenue in the medium term, with margins that will expand and approach the 70% gross margin level. If we keep going, please. Janison is a global market leader in digital assessments. We're 20 years since founding, and our purpose is to unlock the potential in every learner. We operate in a very large and growing market, which is the school assessments marketplace, but we also have a focus on accreditation. Our standardized assessment platform is called Insights, and it's been built in partnership over 10 years with jurisdictions and governments such as the Australian government, the Singapore government, the New South Wales Department of Education, the OECD, and so on and so forth. Our assessment products, which sit on our platform but we distribute directly, are ICAS and PISA-based tests for schools, and they're both flagship, very distinct, unique products in the global marketplace. And our technology platform is focused on high volume, high stakes exams. When we're considered as a trusted, agile tech platform, we've got built-in integrity, we've got built-in technology that addresses the issues of equity. You come to Janison when you have high stakes, high volume, when reputation really matters. It's a space where the barriers to entry are very high. We keep going. Stu, in terms of where we play in the market, we're in a very, very unique and very fast growing space, which is the transition of assessments online, particularly in the schools and workforce marketplace, a part of the market where digital transformation is really nascent, and we're really at the start of what we see as a 10-year growth cycle. We've really seen the digital infrastructure catch up accelerated through COVID, and we're now really starting to see and also starting to focus on the rise of B2C ed tech models focused on directly to schools, directly to parents and students. And you can see what COVID has done to accelerate the transition online. Yet, if you look at the 2021 ed tech share of the total education spend, which is on the bottom of this slide in the middle, we haven't even hit 5% ed tech share. So the market continues to be nascent and growing very quickly. We go to the next slide. It's been a transformational 12 months since we spoke at the last Microcap session. We scaled our go-to-market, we've accelerated our product development, we brought significant new talent into the company. We passed a milestone where our overall staff is more than 50% women, and our executive and extended executive team are also fully gender balanced. We've had a very successful capital raise late in the last financial year, and we've clarified and simplified our strategy. And that's really what's highlighted on this slide. We now have a clear path to what we believe is $80 to $100 million of annualized recurring revenue via 3 growth drivers, and I'll step through those very briefly. The first is our exclusive partnership with the OECD to roll out this extraordinary PISA for Schools product to countries and directly to schools. We've now rolled this out in 15 countries as a platform provider in 9 of them, and as a national service provider in 6 of them, and where the national service provider unlocks a much larger addressable opportunity. And it continues to flourish. Our second growth drive, and we believe that we are on a trajectory to, in the medium term, aim for in the range of $30 million per annum in the partnership with the OECD out of Paris. The ICAS assessment business is a flagship competition that has been around for decades and is known and loved by parents, kids, and schools. It's a competition where, if your child is aspirational around academics, you want to compete and win in the ICAS competition. We'll give you a brief update on the performance of the 2020 ICAS later in the deck, but it's been a very successful year, and with very, very good indicators to suggest that we will see expanded growth next year. We see a path to 20 million plus per annum in ICAS. The final driver is our assessment platform, our Insights Core, and this is where we provide the platform that other organizations use to author and deliver the end-to-end assessment experience, from authoring to running an event, to marking the event, to analyzing the event, to reporting on the event. We've had 6 new logos, significant new logos in the last 6 months. And we believe that this is equally a $20 million plus ARR business. So as we move forward, Stu, I'll pass over to you.
Thanks, David. Good morning, everyone. Just a quick summary of our FY21 year before we move into FY22. Look, I mean, I think FY21 was a phenomenal year. We were very happy with how it went. It was a great result overall in many areas. On revenue overall, we hit $30 million for the first time. That was the highest ever recorded, with almost 60% growth in our platform revenue on the prior year. Pleasingly, we're also seeing most of our growth come through in assessment ARR, so our recurring annualized revenue for our assessment division. That was up 117% on the prior year. And a lot of this revenue growth is driven by those 3 key growth drivers that David just talked through: the PISA For Schools, ICAS, and our assessment platform clients. Another call out on here is our gross margin. We've continued to grow gross margin year on year and half on half for the last 3 years. It's now up to 55%, and we think that there is a lot more still to come in the future years, and we'll talk you through that and how we're going to get there in a second. So moving forward into our sort of medium-term horizon, this gives you I guess an idea of where we believe the business can go to in the next few years, and broken down into those 4 key buckets. So we see a build to around about 80 to 100 million of recurring revenue by FY25, and that would be a business 3 times the size of where we were in FY21. And to get to this target, we've got 3 strategic growth drivers, which I'll step you through. Firstly, we've got PISA For Schools. This is the exclusive partnership with the OECD, and as mentioned, we expect this can deliver up to or around $30 million by FY25. And we see a path to getting there by delivering in over 30 countries as the platform provider, generating about 5 to 10 million, and in 3 countries as the full service national provider, with around about 1,000 schools in each of those 3 countries at $7,000 a school, which would then generate $20 to $25 million. So combining those 2 modes of delivering the test, we believe that we can reach $30 million from PISA For Schools. Secondly, we've got the ICAS competition, which historically has always delivered 1 million tests per annum, and that's been very consistent in the past 30, 40 years. And that was pre-COVID and pre-being digitized by the UNSW. Now fully digitized, it actually has the ability to expand into even more countries. So we can see us growing this back up to $20 to $25 million per annum, which would equate to about 1 million tests a year at a price point of $20 to $25. And then finally, we've got the sort of 10 sets, or a set of 10 clients within our assessment platform that subscribe to our high stakes, high volume assessment platform, and they generate about $10 million a year. We can see this doubling over the next few years to a point where this gets us to around $20 million per annum in recurring revenue. So those 3 strategic pillars combine to about 70 mil. And so with our other existing business units, such as the LMS and our exam management business, and layering on top other acquisitions as well, which we'll talk about in a moment, we can see a clear path to getting to 80 to 100 million in total by FY25. So that was the revenue outlook. In terms of the margin at this point, so as we roll out that strategy of those key growth drivers that I just outlined, we will continue to benefit from the additional volume and the scale in each one, leading to an increase in gross margins as they have done over the past few years. And it wouldn't be unreasonable to expect that with that scale and volume impact on margin, we'd be in the mid 70% gross profit by FY25, as we know that all new clients now that we're signing on are either at or above that level currently. So in a world where FY25 sees us about 3 times the size in revenue, with sort of 80 to 100 million of recurring revenue. That would generate about 70 million of gross profit at a 70% margin and generating significant cash flow at that point. And that sort of rounds out our outlook. So I'll hand back over to you now, David, to talk about PISA.
Thank you. Over the next 3 or 4 minutes, we'll step through our performance and our progress on our key growth engines. In the PISA for Schools space, it does continue to flourish. The last time we presented at Microcaps, we had 7 countries that had signed on. Since then, we've signed on an additional 9 countries to make it a total of 16 countries, actually 17 now. On the national service provider space, we've seen significant uptake in Australia. And since we were accredited and schools reopened just recently in both the US and the 4 countries of the UK, we've seen very good early uptake in both of those markets. We believe that at $7,000 per school as a national service provider, 1,000 schools in each of the US, the 4 countries of the UK, and Australia would set ourselves up for 7 million in each of those markets. And then with our international platform provider offer, where we provide the tech platform to other national service providers, we see potentially another 10 million, and we've again progressed very well in the last few months. If we continue on, Stuart.
Yeah, so just a quick summary of how we're tracking with ICAS this year, currently year to date. So the ICAS sitting window is almost complete now for FY21. We've seen a really good result with 20% growth in overall gross margin, gross revenue, up from 4.8 million to 5.7 this year. And that's really sort of continuing on that trend up towards the 20 million that we're expecting by FY25. That equates to around about 369,000 tests sat or sold, as you can see in the bottom left chart. But more importantly, our run rate for sales orders was on track for between 30 and 50% growth on the prior year, up until the point where school closures really kicked in New South Wales and Victoria and put the brakes on sort of the tail end of our sales window. So as disappointing as it was actually quite pleasing to see the run rate continue on week, growing so strongly on the prior year, which would have put us at a projected total tests of about 500,000 and gives us a lot of comfort going into next year. We also saw quite a reasonable amount of price expansion across the range of ICAS subjects this year, and without any impact on demand, which really validates that sort of price elasticity assumption that we had from the beginning with this product. Another sort of additional benefit this year is we grew our contact base for parents. As we talk about a B2C move into the B2C market, this becomes even more important and valuable, but we added another 40,000 parent contact details into our database this year from sales of ICAS, and that gives us a much greater audience for future product sales of ICAS and also any other associated school assessments or practice assessments. And COVID lockdowns really accelerated, at the end of the sales window, the COVID lockdowns really accelerated our direct delivery of ICAS at home, and that positions us well for a future direct to parent proposition. Back over to you, David.
Thanks, Stu. The third growth driver we mentioned was our assessment platform, and we continue to see both expansion of share of wallet in our existing accounts as well as strong pipeline growth for new customers. In terms of existing customer expansion, I think the headline would really be what we're seeing with Check-In. Check-In was an instrument that was designed with the New South Wales Department of Education to initially determine the amount of learning loss through COVID. It's now, been very publicly in the media communicated that this is now a permanent part of the Department of Education's assessment model. And we're right in the middle of Check-In again right now, and where we expect to see record participation and record revenue as a result. In terms of new customers, as I said, very healthy funnel, and we expect to see deals close and generate revenue this year. Stuart, back to you.
Yeah, so just to sort of wrap up on the sort of growth drivers, we've talked about the organic growth drivers giving us a very healthy future to FY25. We also have a dedicated resource and team internally focusing on M&A and corporate development. and that's really starting to take effect now. And we've seen a huge increase in activity this first half. We made the first acquisition of this financial year very recently. We completed Quats on the 19th of October, and that integration is underway and going well. And we hope to see some revenue and cost synergies come to fruition over the next few months. We also have a very healthy pipeline of other potential acquisitions, and we're reviewing each one very closely, and could potentially be in a position to complete on something in this quarter, if not certainly within this financial year. Back over to you, David, to do the outlook.
Yeah, thanks. As we wrap up here, before I cover the outlook, Michael's had a question around HSE digitisation, and that's relevant, after Stuart spoke about the Quats acquisition. Quats has been around for a long time. It is a traditional pen and paper offer that addresses the need for a raft and a wide array of practice tests in preparation for the likes of the HSC or the VCE. It is a market leader. We have done extensive work to understand when we believe the HSC and so on and so forth will be digitised, and we believe it will be different in every state, but in the range of 2025 and 2026, which means that practice tests ahead of those need to be digitised as well. You don't run a 42-kilometre marathon if you haven't practiced a 42-kilometre marathon before. And so that means that we expect that we'll need to be delivering digital past papers and practice tests in the 2023-2024 timeline. So we have a good existing business, and then the transition to digital will position us very strongly. As we wrap up and provide a sense of the financial outlook, we are on track to meet our expectations and also more broadly our horizon target. We expect strong underlying revenue growth in the first half. We expect the second half growth rate to be higher due to customer acquisition, but also some of the inorganic M&A that Stuart mentioned. We expect to see continued gross margin growth on the first half and the second half. And you should expect to see OPEX will increase year on year, driven by new product investment. Some of the acceleration we've done in the product investment space, particularly to take the opportunity to capitalize on the disruption of COVID. Overall, we're very encouraged with the momentum and performance of the business. So as we pass it back to you, Mark, and I believe there's another open question. Oh no, Michael's just responded. So back to you, Mark.
Thanks, David. Thanks, Stuart, for tackling that open question. We haven't got another one just this second, but maybe I can just jump in with one and keep the ball rolling here. I'm just curious to what extent, pricing power, or how you think about pricing in ICAS. I know in the slide it went from $13 to $15.50 on a percentage basis. That's a pretty decent jump. But price increases going forward, do you see it as a CPI plus, or what's the kind of thinking on how much you can push the ball out there?
Look, I'll cover that very briefly, Mark. We continue to enhance the ICAS product, which brings new value to schools, to parents, and to the kids that participate in this. We are watching price elasticity very carefully, and as you can see, we modestly increased price in 2021, and we saw demand increase. So that gives us really significant comfort. This is a highly differentiated product. It's a competition that spans years 2 to 12 across 6 subject groups. There really isn't any comparable competitive offer in the marketplace. And so, we do see the opportunity as we deliver more value to our customers to lift pricing. I see there are some questions now. From Phil.
You can take whichever one you want first, David.
I'll cover the question from Phil, and I'll ask Stu to cover the question from Graham.
Sure.
From Phil, I think that's important as we look at the competitive landscape, we have to look at it in the particular segments of the assessment addressable market that we operate. So if I very briefly step through our growth drivers, as mentioned just now, our ICAS competition is highly differentiated. We haven't seen as holistic a competition of this type as we've done market scans and market scrapes. We've not taken the product to the US and Europe yet, but there is product development work underway which will allow us to accelerate our globalization, and then we're going to have to be very selective about market entry. In terms of the competition on PISA for Schools, PISA for Schools is an entirely unique product. Unlike other offers which focus on assessing kids or assessing education systems, this is purely about school improvement and giving insights and putting them in the hands of school administrators to improve teaching, learning, and cultural outcomes. It's linked to the blue chip test item questions developed by the OECD, and it's the only product that links both cognitive skills and social and emotional well-being in one and the same product. So really, it's less about competition. It's more about market inertia and our willingness to invest to enter new markets. In the assessment platform space, again, the barriers to entry are very high. There are competitors in the assessment platform space, but it's a very unsaturated market. You can measure the true legitimate competitors in less than one hand. Stuart, over to you on the question about share ownership.
Yeah, thanks. I think that was from George or Graham. Was it Graham? Yeah. So to answer your question, everyone is a shareholder on the leadership team, and a very high percentage, if not 70% of the whole company is in fact shareholders. That's through a variety of things. Some have just gone ahead and purchased personally themselves on market. Some we have a company-wide share purchase plan as well, which 60% of the company have bought into, and that's a personal contribution out of a salary sacrifice. And we also have at the leadership level, we have a long-term incentive plan, which is a 3-year rolling program, which grants equity on the back of performance against 2 measures: return on equity, profitability at NPAT, and total share growth above the index. And so, yeah, so to answer your question, we're heavily incentivized on the back of equity, and we're all sort of have skin in the game.
And guys, I'm just going to squeeze one more in, if I may, before we finish up. In terms of the long-term balance of where you see, I'm just referring to the kind of pie chart where you had, primary, secondary, workforce in terms of the revenue. Where would you see that, or where would you like to see that maybe when you get to the end of the FY25 horizon in terms of the mix of all those various customer segments?
Yeah, really good question. Our focus is on schools. And so you're looking at that school addressable opportunity, which is the largest part of the TAM. We do have a secondary focus on the accreditation market because our tech platform is extremely fit for purpose in that market. And within schools, obviously the assessment platform space is really about that, that digital infrastructure catch-up that's mentioned in the middle of the page. But, we are positioning ourselves with the acquisition of assets like Quats to bolster our ICAS offering. We are now positioning ourselves in preparation for the rise of that B2C ed tech model, where schools, parents, educators, are going to be looking for the likes of a portfolio of assessment instruments, direct to them. So that's where we want to be in the infrastructure and the B2C ed tech space, particularly focused on schools and secondarily on accreditation.
David, Stuart, we're going to leave it there. Thank you very much for coming back in and giving us an update this morning. It was great to catch up on a busy period since you last joined us. If Stuart, if you could stop sharing your screen, because I know the team from Millenium are standing by. And
well, thank you. Just as we wrap up, Mark, thanks for the opportunity to present and participate in Microcaps, and for the participants who joined today. I hope this has been an enlightening session.
Cheers. Thank you, David.
Thanks, Mark.
Michael, Scott, if I'm not sure who's putting up slides, if you could just get them up, and then I will let you know once I can see it. Yes, Scott, it's coming through now. If you can go to full screen mode, please, Scott, if that's possible. Yeah, it's I think just go back to the setup you had just a second ago. Is
that better?
Yeah, there. That's a bit bigger. And if you want to scroll, I think down the page or up the page as required.
Yeah. Okay. Thank you.
So ready when you are, Scott or Michael.
Hey. Thanks, Mark, and thank you everybody for joining us this morning. My name is Scott Alomes. I'm the CEO of Millennium Services Group. I've been here for 5 months and 3 days, but I'm not counting. So, but it is actually great to be in the role. My background is banking and finance, lending, professional services and insurance. But I'm joined today by my colleague, Michael Constable, who's our Chief Financial Officer. Millennium is a stable and sound business, but it did go through some financial turmoil a few years back. And so for the last 2 or 3 years, has been working on a turnaround, and Michael has been intimately involved and played an important part in that turnaround. So he will speak to that. I think it's really important that we acknowledge what happened and explain how we drove that improvement. But certainly for me, as the new kid on the block, it does speak to an impressive resilience and a drive to succeed. Some of the other changes that have been made in the last year include the appointment of a new chairman, Stuart Grimshaw. A number of people might know Stuart. He's a very successful and very experienced business leader, previously been the CEO of Bank of Queensland, and his most recent appointment was CEO of EasyCorp, which is a US-based subprime lender. We've also appointed 2 new non-executive directors, Darren Perry, one of Australia's leading employment and labour lawyers, and Rowan Garnett, a government relations and finance expert currently working with Qantas. The purpose of these changes was to continue to drive the company forward and really capitalise on the turnaround. In a nutshell, Millennium is a retail planning and security business. I think first and foremost, though, it is actually a people business. And so team member engagement is absolutely critical to our success and ensuring that we deliver to the high standards expected from our clients. We have maintained a considerable number of relationships over a long period of time. And for me, that speaks to the strong partnerships that have been forged. We have traditionally operated, as I said, in the retail planning and security areas, but also have diversified into government, education at all levels, and commercial. And we certainly have expanded our service offerings to include concierge and facilities management. In terms of the market, there are a high number of small players and a few larger players. And where Millennium fits in terms of that whole market is really being somewhat of a mid-level player. So what this means is that we're uniquely placed to be nimble and agile. So a good example is we provided security for the pop-up vaccination centres in Victoria with 3 days notice. But importantly, we're big enough to ensure that the compliance, governance and risk matters are appropriately managed and that all of our team members and customers are suitably protected. So for example, we pay to the Modern Award and we're proactively adhering to the Modern Slavery Act. So that's just us in a nutshell. I'll hand across to Michael now to talk about the turnaround. Thanks, Michael.
Thanks, Scott, and morning all. Thanks for your attendance today. Just by way of background, so I'm CFO of the business, have been for the last 3 years. Before that, 10 years chartered accounting, 10 years in finance roles in NILEX and program groups, and then 10 years as CFO of Tox-Free Solutions. There's a lot of similarities with the Millennium Group, where there were some great opportunities in the marketplace. Did a good job diversifying geographically, service line, bulked it up, and ultimately sold to Cleanaway for a great return for shareholders. And certainly some of those features are what I see in the Millennium business, in that we'll talk more about the market, but yeah, significant opportunities around both organic and inorganic opportunities in the marketplace and where we're situated. The business has done a good job in previous years in building scale to the business. Certainly, we've got very good customers, and a national scale, both through Australia and New Zealand, is critical to being able to tap into those national contracts, and that acts as a really good barrier to entry to a lot of the smaller players, and we've successfully sort of overcome that scale of the business. Most importantly, we've got really high levels of contracted revenue in the business. So we've got a contract book, greater than 600 mil. And that the composition of that really is that, about 90% of the total revenue of the business is contracted in contracts around 3 to 5 years. They have, annual adjustment clauses around labour charges, pass-through charges of, if there's taxation authority changes and the like. And the other 10% is really ad hoc work, which is scheduler rates work, where there's more profitable and the opportunity to on-sell and grow your business. And it's been one of the main features of what we've been focusing in around our turnaround. And certainly we've got some great customers on board, good asset owners, Centre Group Vicinity, JLL, Stockland, some good government contract work, Colliers. But unfortunately, what we had been experiencing was some significant financial issues that Scott referred to. Whilst we had grown rapidly the revenue, we were facing falling margins, particularly falling gross profit margins. And we were facing some impairment issues and, really just loss of focus on some of the drivers of the business. And so what we needed to do was move quite quickly, which we have done. And we had devised and now successfully executed an 11 million profit improvement plan. That was predominantly focused around the contract book itself. It's great to have a good sized contract book, but obviously the concern is that, you want to have a quality contract book. So we've over the last couple of years performed a contract by contract review through the contract book. And that's resulted in us actually handing back some of the contracts that weren't actually good for us. So in the last year, we're sort of a bit smaller, but certainly it's helped us probably focus on the right customers for who we're well pitched to service. Labour management for us, it's about 85% of total costs in the business, and spent a lot of time working through our approach to labour management. And what we found was that there was certainly some roster creep in terms of us performing additional work, and in that core contract and in the ad hoc sort of part of the business, we're also performing work that we weren't appropriately capturing back through the revenue cycle of the business. So we've tightened that up. We've implemented a time and attendance system throughout the business, and that's really based on a facial recognition, clock in, clock off. But more importantly, it probably has the interprets the time, compares back to the set rosters that we have, throws out a dashboard style of reporting of variances, which has enabled us to have significant improvement in labour management through the business and really driven some impressive margin growth. We've also moved through onto the modern award in both the cleaning and security business, and really tightened up the use of some subcontractor quality and use within the business. So if I had to summarise what that's done for the business in the last couple of years, we've really moved from, the all-important labour to revenue. Margin is the key driver for our business. So we've gone from, an 84% ratio down to about 78% at the moment. We think there's future improvements through some of the smarts in the business and innovation. So if I had to summarise the turnaround, through the focus on those main parts of the business, we've really sort of gone from a 2.5 million EBITDA loss first half 19 to plus 11.5 million normalised EBITDA for FY21. We've now completed that turnaround. We've removed all debt from the business. Previously, we had about 30 million bucks. At the end of June, we got back to a nil net debt situation. And, we've really turned the margin around. So now we're, for FY21, it was a high 14s GP. And we're targeting about 15% GP as a sustainable go forward base and 5% EBITDA margins. So now that we've successfully overcome sort of, a repair of the business and restored the cash flows, the credibility and the capability in the marketplace, it's all now about overlaying the revenue opportunities that we have. And the good thing for us, we've already invested in our overhead structure. And so we think we can add significant revenue in with very little additional overhead increase, which will, again, fall through nicely through to EBITDA. So Scott, might just hand back to you just to talk about the opportunities that we have.
Yeah, thanks, Michael. The thing that I've really noticed in the time that I've been here is the competition remains really strong. Margins are definitely being squeezed and innovation really continues to operate at a very strong pace. So the 3 prongs of the strategy that we're looking at going forward is, number 1 is maintaining value-added service propositions. In my time here, I've seen a number of customers extending contracts rather than go to tender because, in their words, the value proposition that we bring, including service standards and the partnerships that we have established, enables that to proceed. It doesn't mean that we can rest on our laurels, and we are constantly and proactively reviewing our operations to add value to our clients, expand our service offering and make joint improvements. One not great example is we did lose a big contract in around about August, September. That was QRC. We had maintained the relationship with that customer for like a decade. But it's a really good example. And the reason I mention it is the fact that margins are being squeezed. And it's something that we constantly have to focus on in terms of how we operate going forward. So we constantly reviewing that contract book. We're constantly keeping in touch in terms of where our customers are at. And we're constantly focusing on the voice of the customer and looking at that competition. The second prong is the market rationalisation. We're seeing, whilst the competition is strong, there is also a huge opportunity to rationalise in the market. And that creates the opportunities for us, given that we're in a strong cash position, to actually take that forward. And it also enables us to diversify our opportunities so that if we want to expand into other businesses, we can do that through the acquisition process and not just through the organic process. As I think most people would understand, if you want to start to develop into new industry segments, it's going to take you time to actually establish that. And a quicker way of doing this through the acquisition model. So we're very focused on opportunities as they present us going forward. And that is a major tenet of our strategy. The third and final prong of the strategy is around technology, the automation and digitalisation, which is seen as a complement to the people. So Michael talked about our time and attendance and rostering system. That is making a huge difference in terms of looking at the reporting that comes out of that process and making sure that we adhere to the contract requirements from the customer, but being able to look at the service delivery component as well, and what other opportunities that actually creates. So it's not just a cost-saving exercise, and it's a really good focus for our team members. It also creates that opportunity to look at what else we can actually deliver there. We are currently using robotics for cleaning. We work those through night shifts because it's an automating process that is proving to be relatively successful. I think it's one of those things that's fairly new technology in a sense that it's been around for about 5 or 6 years, but there's been a lot of sort of teething problems in terms of actually how that rolls out. But we're finding that we're starting to get good traction with regard to the use of robotics for the night shifts. and we're getting very strong and positive feedback from our clients in that usage. Another example is looking at traffic flows. So currently under the contracts, our cleaners, for example, will have rotations of 20 minutes in the areas of which they're meant to clean. The utilisation of apps looking at traffic flows in certain areas can really inform how frequently areas need to be cleaned. So particularly areas like food halls, we can actually increase the rotations by looking at the traffic flows from the apps in other areas that are used in, say, a shopping centre, for example. And we're rolling that out as we speak across a few of our clients. Very much with automation and digitalisation, it is important that you establish a very strong relationship with your customer so that the customer understands what's the value add with that. And in some cases, what we're doing is setting up almost like a mini joint venture in terms of what automation we actually implement with a customer. So there's sort of the three main strategy prongs that we're focused on at the particular point in time, and we see those as the ones that will take the company forward and lead to the turnaround, continue the turnaround that has been so successfully delivered. So that's us in a nutshell. So back to you, Mark. Any questions?
We haven't got any from the audience just a second, but I have a few. Maybe I'll just kick off with to get the ball rolling. I don't know if this is one for Scott or one for Michael, but cost pressures on the wages front, you know, with the, I guess, lack of immigration into Australia in the last 2 years, you know, we've seen service jobs, you know, really rocket up in the wages being offered in the US. We've heard plenty of noises from other sectors about cost pressures from, you know, lack of staff, mining, agriculture, and that's, you know, in Australia as well. I'm just wondering what you guys are seeing like on the ground in terms of wages pressure, just purely having to up wages to actually get staff.
It's not a wages issue because we pay to the modern award. However, the vacancy rates in certain markets are definitely through the roof. We do utilise a proportion of international students, for example. And so one of the things that we've been focused on is lobbying the government to enable cleaning and security to be given that exemption of the limit of the 20 hours. So I know that hospitality and retail have been given the opportunity to be exempt from limited to the 20 hours and move it to the 40 hours. We can't really understand why cleaning and security wouldn't fall into the same boat of retail and hospitality, given that those two industries actually create the mess that we need to clean up. So we continue to lobby on that. So we've got fairly high vacancy rates in Western Australia with regard to that. So it's not a wages pressure issue, it's actually having bodies that we can recruit to help us out in that regard.
And I'll take one from the audience now. I'm guessing, yeah, you do use subcontracted labour, and if yes, how do you manage the compliance risk?
We would only use subcontractors for ad hoc requirements. We really have a stated policy of paying to the modern award. So subcontractors is not something that we would actually use.
Okay.
And when we do use them for the ad hoc part, really what we're doing is instituting through our quality and risk management systems checks that, you know, obviously the concern is that in turn our subcontractors are not complying with the relevant obligations. So we have an active process of supplier reviews with them, as in turn our customers do with us. So it's certainly the transparency on this issue has improved, and us as a public company, you know, we think we are right at the forefront of good governance in this area, and we expect the same with our suppliers. So it's really through an active management process of onboarding and then regular reviews with our subcontractors that are used.
Yeah, the compliance, licensing and training of any ad hoc subcontractor is exactly the same as a permanent team member.
Okay, great. If I can just one on maybe on the acquisitions strategy. What are you guys thinking in terms of, is it more, a few tuck-in acquisitions here and there, or, one larger one to kind of get you a beachhead in, a particular market or a particular industry segment, or, is it going to be a combination of both?
Tell you about, Mark. Yeah, it's a combination of both. It's where it actually makes sense. I mean, we're looking at mainly looking at acquisitions, but it is a mergers and acquisitions model. There's also joint venture opportunities. So yeah, it's where it actually makes sense for us in terms of the strategy around maintaining service standards, rationalising in the market, but also diversifying our portfolio. And
just on the 10% ad hoc business, I'm just wondering, as New South Wales opens up, Victoria opens up, other states open up, are you seeing a lot of inbound inquiry, inbound demand from event organizers, concerts, shows, all of that, which drives the security side, and I'm guessing the cleaning side post these events? What is the kind of feel for that side of the business? Are you expecting like a big calendar year 22 with everybody wanting to go to events again?
Yes, definitely. I mean, we still adhere to the COVID restrictions. So MRC is one of our customers, but we do actually see an increased demand in that regard, definitely. But some of those are existing clients, and so we're just providing to existing contracts. There will be ad hoc requirements, but a lot of it will just be from existing contracts.
So it's a case of more just picking up where you left off with these customers pre-COVID.
Absolutely. I mean, as I said, there will be ad hoc. We've even done some ad hoc for other providers because they can't provide the service. We do models like that as well. So it just depends. It's keeping really close to the market in terms of the opportunities. So, for example, the pop-up vaccination centres in Victoria, that was through a relationship that we had with the Department of Health. And it's making sure that you can actually deliver. So if you're looking at you've got to have the people, because it's a people business, to be able to provide the service.
And then one for Michael. I know you talked about the contract book and handing back contracts where it didn't make sense, but if we exclude those, what would be an average, I guess, churn in the customer base overall on the contract book side?
Oh no, we've got really high retention rates. So we have, what in terms, I suppose the first question is, what's the pipeline look like? And we've got an even spread of about 25% of the revenue stream that comes up each year. And out of when they come up, because of the work that we've done, we relatively, it's probably a 90% retention rate. And as Scott described before, we did lose QIC, who we'd had for a long time, which was a bit of an aberration, and it shows that, you don't take anything for granted. That's the nature of the market we're in. However, we've worked hard on our service delivery, which underpins retention, and really the profit improvement plans that we've done has enabled us to remain competitive in our quoting, yet deliver, good margins within the business.
And another question from the audience on the security offering: is it purely manpower based, or does it include a bit of electronic surveillance and monitoring, etc.?
Yeah, it is a combination of both. We established a National Operations Centre in, I think it was around about July this year. And yeah, we're using technology where it actually can provide a lot more security to the actual security officers. And we're looking at our robotics piece on that particular aspect. So a good example of the National Operations Centre, there was a gas leak at one of the centres. And so the security officer could stay in the control room at the centre, and the National Operations Centre managed that in getting the plumber out to solve that problem, so that it was a far more efficient sort of process. So it's really a combination of both. Regard to that, a lot of it is around making sure that we can actually provide security for security, if that actually makes sense.
No, yeah, exactly. I think, let me just double check on time here quickly. If we don't have any further questions, I think we might leave it there. We might just finish a minute or two early. But before we go, Scott, Michael, if anybody wants to get in touch, if they have further questions or want to line up a one-on-one or get on a IR mailing list, what would be the best way to get in touch?
Yeah, they can contact us direct. We're more than happy. I'm happy to have conversations. We do have a communications function, but I think for this purpose, it's just contact us direct.
Okay, no problem. Okay, I would like to thank Scott and Michael for joining us this morning. And as I said, the recording will be up on the Coffee Microcaps YouTube channel tomorrow morning. And with that, I'm going to close this morning's meeting and wish everybody a good rest of their Thursday.